Good day, and thanks for joining us for our corn and soybean update on the respect to the corn and soybean outlook. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture. And joining me today are my colleagues, Dr. Nathan Thompson, who's an Associate Professor in the Department of Agricultural Economics, and Michael Langemeier, who's a Professor in Ag Econ and also the Associate Director of the Center for Commercial Agriculture. So we're having our webinar today in light of the fact that earlier this week, USDA released updated world ag supply demand estimates. And so we thought we'd walk through some of that and some of the other aspects that are influencing the corn and soybean outlook. So let's just kind of summarize some of the information on the corn side. Some changes on the U.S. corn balance sheet for the 2020 crop year. USDA increased feed usage by about 25 million bushels. No change in projected exports of corn. No change in projected ethanol usage of corn for the 2020 crop year. That wound up reducing the projected carryover by about 25 million bushels to a total of about 1.08 billion bushels. That's about 7.4% of usage. So still a pretty tight carryover situation from the 2020 to the 2021 crop year. They did raise the marketing year average corn price estimate by a nickel to $4.40, and that's simply reflecting the relatively strong prices we've had this spring so far in early summer. Looking at the 2021 corn balance sheet, they raised the production estimate by 175 million bushels, and that simply reflected the acreage coming out of the June 30th acreage report. There's no change in the yield estimate. USDA won't be updating their yield estimate till next month. No change in projected ethanol usage. That's still standing at about 5.2 billion bushels. They did raise projected exports for the 2021 crop year by 50 million bushels. That puts it at 2.5 billion bushels. That's still about 12% below the 2020 estimate, reflecting expectations for some smaller exports going to China primarily. They raised projected ending stocks at the end of the 2021 marketing year to 1.43 billion bushels. That's about 75 million bushels more than on their June report. Ending stocks at the end of the 2021 marketing year are projected to be just a little below 10%, 9.6% of usage. On the world side, they reduced Brazil's current production in the current year by about 5.5 million metric tons, but simultaneously raised the estimate of Argentina's production by about 1.5 million metric tons compared to their estimates from a month ago. No change in China's expected imports from all sources compared to the June estimates that they published just in mid-June. It's always interesting, I think, to come back and look at the corn ending stocks forecast for the 2020 crop year month by month that have been published by USDA. And of course, going back to last June, USDA was forecasting a carryover from the 2020 crop into the 2021 crop year of about 3.3 billion bushels. That was coming down somewhat over the course of the summer, dropped sharply as we headed into the fall and into the winter months. And I think, one of the surprises maybe for us, Nathan, was the fact that you look back at January, February, and March, and we were kind of hovering at about that 1.5 billion bushel expected carryover. And we kind of thought we were done at that point, that was probably going to be the final forecast. But it has kept coming down, and now we're just barely above a billion bushels. So, you think about the strength we saw in corn prices this spring. A chunk of that's related to the fact that reducing that carryover by over 400 million bushels compared to what we thought we were going to get back in March, right?
That's right. I mean, prices have kind of just been on a wild ride since last fall, and this chart really explains a lot of what's driving that fundamentally.
If you look at ending stocks as a percentage of usage, which is a nice way to scale ending stocks so you can look at it over a longer time frame, you can see that we're still pretty tight by historical standards. Ending stocks this year just above 7% coming into the 2021 marketing year. You go back to 2012, that's really the last time we saw ending stocks at that 7% level. 2011 we were at 8%, 2013 we were at 9%. If you look at 2021, we're still only projecting roughly in round numbers about a 10% carryover. So even with a rebound here in production in 2021, it looks like a relatively tight carryover into the 2021 marketing year. The wild card, of course, continues to be what's going to take place with respect to yields, and we'll talk more about that in just a bit. If you look on the world side, world corn stocks-to-use ratios have come down substantially over the last 5 years. 2016 crop year, we were at 33% carryover on a worldwide basis. We're down to about 24%, just a little over 24% this year. A small increase projected for the 21 crop year to about 25%. If you look at this month's numbers versus last month, World stocks estimates outside China were estimated to be about 1% below where they were just a month earlier. So maybe just a little bit of tightening on the world side, particularly when you look at it outside China. A lot of interest in what's taking place with respect to exports, particularly as we get to the end of the marketing year. Those weekly exports, looking at exports through the end of June, the various marketing years going back to 2015, you can kind of see how things compare. This year, we're at about 81% of USDA's projected export total. This time last year, we were at about 77% of their projected export total. And you look at some of the prior years, we've been ranging from about 73 to maybe 84%. So if you look at it from that perspective, odds are pretty good that we're probably going to hit the export target, but not likely to exceed it at this stage. And then if you look at our exports to China versus exports to all destinations, the strength in exports this year has really come about because of China's pretty radical change in their import policy, importing so far this year almost 700 million bushels out of the 2.3 billion bushels that we've exported so far this marketing year. That leaves us total corn exports up about 68% compared to last year. And those increase in exports to China really accounts for almost 72% of that increase. And still a question mark as to what's going to happen the rest of the summer. What will China do over the rest of the summer? Michael, I know you've looked at that in the past.
Well, certainly corn production in China is very important, and corn stocks. We've talked about that previously. It's very difficult to get a handle on actual corn stocks in China, and so that's going to be important, particularly for this year's crop, to see how large their crop's going to be, and then how fast their pork industry is increasing or getting back to where it was previously, and so those are all wild cards related to corn imports to China.
Yeah, there's a lot of interest in what's taking place in the swine industry in China. There's reports this week talking about China liberalizing policy a little bit to encourage small farmers to rebuild their hog herd. They're clearly trying to rebuild pork supplies domestically, and so that continues to be of interest and really is going to be a determinant of what happens with respect to corn exports from the U.S. to China next year. So that's still up in the air in terms of what's going to happen. The other question mark is what's going on in the ethanol market. Interesting development here these last couple of months, looking at the monthly averages. This is coming out of Nebraska Energy Statistics, so where they track monthly averages for both ethanol prices and unleaded gasoline prices. Ethanol prices the last couple of months have actually gone above unleaded gasoline prices, and that's rare, right? Normally you think of ethanol being blended in and helping pull down the blended price of gasoline that retailers are able to sell to consumers. That's not been the case recently. Very interesting development. If you look at the ethanol plant margins, this is coming out of some data from Iowa State University where they track ethanol plant operating margins above variable cost going back on a daily basis. And I've got a chart here going back to September of 2019. You can see how those margins have really narrowed in the last, 6 or 8 weeks. Going back to early May, we had some really positive margins in the ethanol sector. About 60 cents per gallon or better. More recently, those margins have been between about 10 and maybe 20 cents per gallon. Most recent data that we had was actually 15 cents. So still positive, despite the fact that those ethanol prices have moved above gasoline prices. But clearly those ethanol margins are under some pressure. And that kind of leads you to be a little bit concerned about where ethanol production might be headed here this summer. However, if you look at the weekly data, going back not compared to last year, but rather to 2019, to get an idea as to what's happened to ethanol production in the today versus the pre-pandemic era. This most recent data, the very last week of June, ethanol production actually rose above the same week in 2019. That's the first time that's happened going back to the start of the pandemic. So that's actually a positive sign with respect to corn usage going in ethanol the rest of the summer. But that is a little bit of a wild card with respect to what we might use here over the next several months, actually. We mentioned yields, and Michael, I know you've taken a look at this. The drought monitor, and we have to kind of caution our viewers, the drought monitor, an updated one will come out tomorrow. So this is still last week's drought monitor. But it suggests that we've still got problems in North Dakota, South Dakota, spilling over into chunks of Iowa and a good bit of Minnesota as well.
Yeah, when you look at the crop conditions, which we'll look at a little closer for Indiana and the 18 states, but when you look at crop conditions for corn and soybeans for that matter, in North Dakota, South Dakota, and Minnesota, the percentage of the crop rated good or excellent is very, very low compared to the average for the rest of the states in the U.S. If, for example, the average for the U.S. has been running about 65% good to excellent for corn. In Minnesota, it's about 40% good to excellent, and North and South Dakota, 35% good to excellent. Very low numbers compared to the rest of the country. And as you indicated, Jim, these are very important corn states. Minnesota is estimated to plant 8 million acres of corn this year. Roughly 9% of total U.S. acreage. North and South Dakota are also big players in terms of corn production, close to 10% of corn production. So you've got 19% of corn production in states with very low good to excellent ratings for corn.
Yeah, and so in very large percentages on the soybean side too. And we have to caution because we know there's been some moisture since this last drought monitor was posted last Thursday. So their question mark is how much fell and how widespread it was, and it's a little unclear at this stage as to how much alleviation of the drought conditions we've had. But we were talking about this before, Michael, and you kind of pointed out that on the corn side particularly, even moisture now doesn't completely solve the problem, right?
Yeah, and even if you get some moisture now, you're not going to go from 35 to 40% all of a sudden to a great crop. And so that's the point that's important to point out is you're going to see some lower yields in those regions, very likely.
Yeah, some damage has been done, especially in the Dakotas. Maybe not so much in Iowa. That's a little less clear. But it's going to be interesting to see how that shakes out. So I'd encourage our listeners to pay attention to the drought monitor when it gets updated tomorrow. You've taken a look at the vegetation as well.
Another way of looking at that, this is the WASDE report presents USDA Vegetation Health Index, and green and blue means that the plant is pretty healthy, and red and orange not so healthy. And as you'd expect, very similar to the drought monitor, North and South Dakota, particularly that eastern part, that's heavy corn soybean region, but also Minnesota where there's a lot of corn is orange or red. Whereas when you get into southern Iowa, at least the southern half of Iowa, most of Illinois, Indiana, most of Ohio and Nebraska, Kansas, Missouri, they're more green and blue. And so certainly from a vegetation health index, it's that region, North Dakota, South Dakota, and Minnesota.
Yeah, our part of the Corn Belt here in Indiana and much of the eastern Corn Belt and really the central Corn Belt has actually been in pretty good shape with respect to moisture. Missouri has been overly wet. Parts of Illinois maybe have been overly wet as well, but nevertheless, certainly not suffering from drought.
And the northern half of Iowa, that's where it shows up in the drought monitor too. The northern half of Iowa, it's a little bit uncertain yet what that crop's going to be. It's not quite as good looking in terms of the vegetative health index as southern Iowa.
You took a closer look at those
crop
conditions.
Yeah, looking at the percentage of corn ranked good and excellent for our Indiana viewers. Corn in Indiana looks pretty good. Right now, good to excellent for the latest data for the week ending July 11th was 73% ranked good and excellent, with very, very small percentages in that poor and very poor. And so most of the remainder is in the fair category. That's very positive. You compare to the 5-year average, is only 59% for this time of year for Indiana. And we've got to remember, though, that we have 2019 in there, and that 2019 was not very good. And so we've got that average in that 5-year average. I also want to point out that Indiana is better than the 18 major states, but you got to remember North Dakota, South Dakota, and Minnesota are in those 18 major states, and Iowa's a little lower than Indiana too. But so Indiana, the percentage of corn ranked good and excellent is looking really good compared to the 5-year average and the rest of the country.
So we've made a case for the markets paying close attention to weather patterns the next few weeks with respect to identifying what the yield prospects really are. And they're going to pay very close attention to what's going on in the Dakotas, Minnesota, and Iowa in particular, because those have been the trouble spots, right?
Yeah, and every week we get the crop progress report. They're going to be looking at that very closely to see what the crop progress report is for that northern plains, Minnesota region.
Crop progress reports and the 6 to 10 day forecast are going to be the words to live by, I think, the next few weeks. So, Nathan, you've taken a look at what's going on in corn basis here in Indiana in particular and around the Corn Belt.
Yeah, so just kind of taking a look at what's been going on with basis. Here we're looking at corn basis for central Indiana. and we're looking at the 3-year average, and I'm specifically looking at basis for the whole crop marketing year relative to September corn futures, so September of 21 corn futures. And so this chart comes from the Center for Commercial Agriculture's crop basis tool, which is available on the Center for Commercial Agriculture's website. And so just a little bit of context here. So the blue line that you see there is that historical average, right? So that's the historical 3-year average corn basis, the most recent 3 crop marketing years. And then the black line is what's happened throughout this crop marketing year. So starting in the fall of 2020 through the current time. And so really what I want to focus on is what's really been happening here the last 2 or 3 months with respect to basis. And so we've had strong basis throughout the crop marketing year and really saw a lot of strength there in May as there was some uncertainty about acreage. That has kind of leveled off, and we even saw a little bit of a dip there in June. But relatively speaking, right, basis continues to be pretty strong for corn, at least here in central Indiana where we're looking at, maybe down in that 30 to 40 cent range compared to where it was in May. But, given how high it is, that's really not that big of a dip. And so, we've talked a lot about, what corn basis might be here over the next several months in previous webinars. And it's really getting harder and harder to kind of know what's going on here. As you think about, how late we are in the marketing year. And like you said, weather is going to really play a big factor here as we think about what's going on, as well as what's going on down in Brazil.
And you've taken a look at this from a research standpoint over the last 3 decades. And we're in the time of year when forecasting basis is really hard.
That's right.
It's extremely variable in July and August, right?
That's right. I mean, even going back into May, it can be quite hard to kind of predict. Once we get to the point where we start thinking about new crop, right? And so in that May, June, into the summer months, it just becomes much more volatile, right? Basis kind of can tend to go one way or the other depending on what's going on in the market. And so, yeah, it can really bounce around a lot in one direction and the other very quickly based on the information that the market presents. So the other thing that we've been looking at that I think is useful and kind of ties into some of the charts that you showed previously as it relates to kind of corn demand side of things is ethanol plant basis. And so for folks that have kind of followed along with the webinars from month to month, I've been showing this chart, but this one looks a little bit different. And the reason is, again, as we move in kind of to the latter part of the marketing year, previously I have been showing this on kind of a nearby basis calculation. And here I've calculated basis again relative to that September futures contract for the entire crop marketing year for each of the years that are up here. So, if for some reason you were to go back and look at the previous charts, you might say this looks slightly different, and that's kind of the reason why. But the trends really are the same, and the information that you get out of it is kind of interesting, right? So again, just for some perspective here, we've got several lines. The blue line is kind of the 2015 to 2017 average ethanol plant basis for the state of Indiana. I just aggregate everything together to kind of get a general sense for what's going on there. And the reason that's kind of serves that 2015 to 2017 average serves as a little bit of a baseline, a normal, so to speak. And the reason those are the 3 years that are normal is there's been several kind of odd or kind of unusual years here over the last several years as it relates to what's going on with corn basis and as it relates to ethanol demand for corn. And so, 2018, 2019, we see at the end of the crop marketing year, basis really got hot, and that had to do with planting conditions in the spring of 2019 and the demand for corn from ethanol plants not knowing what the crop was going to look like in the fall. Then we see the red line there, that's 2019, 2020. We know we had the pandemic and the huge impact that had on gasoline demand and thus ethanol. So we see this big dip in corn basis there in the spring of 2020. And then the black line is what's going on this year. And so you can see there's been this kind of just really steady strengthening of basis. And if you go back to the beginning of this year, the beginning of 2021, we've seen basis increase 77 cents from the beginning of 2021 to now, which is pretty remarkable increase. And when you put it in context of some of the other kind of quote unquote shocks that we've seen the last several years, whether it's the pandemic or the 2019 planting issues, I mean, ethanol plant basis is very strong relative to some of the previous information that's on the chart. Now, as you alluded to, right, we've seen that price of ethanol go above the price of gasoline. We've seen those margins at ethanol plants dip. So where is this going in the future? It's kind of hard to say, but at least where we're at presently, ethanol plants, are definitely being competitive in the terms of the way they're bidding for corn.
So I think what's going on is as gasoline usage goes up to meet the mandates, we're seeing people continue to bid strongly for corn going into these ethanol plants. So to me, it probably hinges pretty much on what happens with respect to travel demand here in the U.S. If we see ongoing strength in travel demand, which appears to be the case right now, so I don't see any indication that that's backing off. That suggests maybe we'll continue to see those ethanol production numbers remain above year-ago levels, which suggests ongoing, relative strength in the ethanol plant basis. I don't see a good reason for that to disappear in the short run. So in the past couple webinars, we've talked a lot about whether or not we could see an end of marketing year pop in basis. And I don't think we put any of those charts in today, but just let's revisit that a little bit. Sure. Because there have been some years where it got pretty crazy, right?
Yeah, well, and it's a little bit challenging. So again, I talked about why I didn't show the nearby basis charts. So as we kind of roll futures contracts, and so recently we've rolled out of July into the next nearby contract for corn would be September. And that September contract was trading at a pretty big discount relative to July. That's what the market was giving us. And so when you roll out, you kind of see basis increase just mathematically, right? Basis is cash price minus futures price. So as that future price dropped, as we rolled to that next contract, basis is really strong right now, right? Like if you look at corn basis bids, they're somewhere in the ballpark of $1 a lot of places, which even historically speaking is strong. The question that you have to ask yourself is kind of, what's going on there as it relates to, the futures market maybe wasn't giving us the futures price that a lot of local bidders are thinking was needed to kind of get corn out of the bins or anything that's left. And so, we've hit or exceeded the targets that we had put out there, but I think that had more to do what was going on the futures side than what's going on the basis side. It's kind of a function of both of those things. So certainly there are opportunities. Basis is hot right now, but again, the futures price is relatively lower than where it has been in the past several months as we've rolled to that next nearby contract. And so the cash price really hasn't changed, I guess, is the point that I'm trying to make here. So cash bids have stayed relatively constant, and basis has been what's been used to make up for that drop in futures.
So, thinking about what might happen in August, I guess we just want to point out to our viewers and our listeners that it's going to be a challenge to anticipate what's going to happen there, right? Yeah. I mean, it's going to be pretty volatile. There might be another pop out there in terms of basis, but as you stand here today, particularly as we look at prospects for good crop development here in the Eastern Corn Belt, the odds probably don't favor it this year. Do you agree with that? Yeah,
locally, based on all the information we have and the fact that we're in a pretty kind of strong, we're depending on weather at this point in the year, locally, I don't see much chance that we're going to get basis pop much higher than it already is.
That's kind of where I wind up.
Yeah.
I guess we'll find out in about a month if
Sure.
we're right, but okay. So you've taken a look at new crop pricing opportunities.
Yeah, so we've been pushing this, obviously for a while with the strong prices that we've been seeing, getting people to start thinking about some new crop opportunities, or at least, get in the mindset of thinking about what's out there. So this morning I pulled off the new crop December corn futures. We're at $5.43 a bushel. I adjusted that for an expected corn basis. I calculated that using the crop basis tool. You could kind of use information in your own region. I use Central Indiana just kind of a middle point there. That's about 15 under, so that would put you at a cash price of $5.28. And so kind of to put that into perspective, I threw a couple charts in here to just kind of get us thinking and maybe go through a little bit of a mental marketing exercise. And so this chart here is new crop December corn futures going back to last fall. So December 21 going all the way back to the fall of 2020. And obviously we all know we've had a run up in prices here over the last year or so. But what I really want to focus on is the last 3 or 4 months going back to end of April, beginning of May. And you can just see there's just been immense volatility in those markets with ups and downs. And so clearly, we're not at the highs that we saw in the last several months, but don't let that cloud your judgment on the sense of what a $5.43 futures price, and then again adjusted for basis, that $5.30 or so cash price is in terms of profitable, right? So Michael calculates our kind of break-even levels on corn, and that's certainly above most people's, well above most people's break-evens. And so, I think, Jim, you made the point earlier, right? If you look at those bars on the chart here, just because you missed the 5 or 6 or 10 days that were at the top of that market, don't let that kind of mess with the mental accounting of, well, I missed the peak, I don't want to sell anything. If you haven't made any moves, we're still at a point where I think that folks should be locking in at least small portions of that new crop to lock in some of those profitable levels, because as I want to show on the next chart, there's still downside risk in these markets, right?
Yeah, let's talk about that downside risk. So explain how you're computing this or how you arrived at this.
So this is the Farm Doc team over at University of Illinois has what they call this price discovery tool. And so this uses futures prices and option prices to kind of quantify kind of the risk that's in the market currently. And then they basically put a distribution. So based on where today, so this, it's constantly kind of updated whenever you go to the site. Wherever the current futures price is for corn, it gives you a distribution of where that price could be come this fall at expiration when that contract goes off the board. And so to calculate that, I just said, okay, well, if today's corn price is there in that $5.43 range, based on the current information that the market knows, you plug that into the tool and it can tell you kind of what are the chances that the price goes up or down in a certain direction. And I said, okay, well, what kind of downside risk are we facing here? So what is the chances that we see corn futures price decrease by, say, $1 before we get to the fall? And if you plug that into the tool, it tells you that there's a 20% chance, a 1 in 5 chance that corn futures price can go from where it is today, $5.43, down to $4.43 or lower by this fall. And so, as you think about kind of, probabilities and the chances of that happening, there's serious downside risk. The market could absolutely move strongly in that direction. A dollar move, which again, I just showed you, a dollar move is nothing these days, but there's a good chance of that being able to happen between now and fall time. And again, I showed last month some seasonality charts. We're certainly in the time of year where we start to see prices revert towards those harvest time lows. And so that's certainly the trend that I would expect to see here over the next several weeks.
Just to reiterate what Nathan's been talking about here, you look at cash prices, let's assume a similar basis, you're looking at the difference between $5.30 and $4.40 corn. There's a 25% chance that cash corn could be below $4.40. That's getting closer to break evens. And so I'm just encouraging people to think about some marketing strategies now, just in case that we do see that $4.50 corn.
And to maybe turn that around a little bit, Michael, you got an opportunity today to lock in corn prices that are probably in the ballpark of $1 a bushel above break even. I like to think of it that way, right?
That's a very good way to think
locking
about
at a positive margin of $1 a bushel.
And that's not very. That's
There's
pretty
not many
unusual.
times in history
pretty unusual
you're
able to do that.
Yeah. So that's an important point to remember. All right, let's kind of summarize what USDA had to say on the soybean side. They reduced their estimated imports by 15 million bushels to just 20 million bushels total, so down from 35. They reduced the soybean crush estimate for the 2020 crop year by 5 million bushels. That puts the crush at 2.17 billion bushels. They reduced exports by a small amount, 10 million bushels, to 2.27 billion bushels. Left the carryover unchanged at 135 million bushels, and that's equal to just below 3% of usage. And then they reduced the marketing year average soybean price estimate by 20 cents a bushel down to $11.25. On the 21 crop balance sheet, no change really in the balance sheet projection because there really wasn't any change in the acreage on the June 30th acreage report relative to what the planting intentions report suggested. They did lower the marketing year average soybean price projection for the 21 crop by 15 cents to $13.70. On the world side, no change in Brazil's current year estimated production. They did reduce Argentina by about 500,000 metric tons. No change in their preliminary estimate of Brazil or Argentina's harvest that will take place in early 2022. And they reduced the current year estimate of China's imports by 2 million metric tons and reduced their forecast for next year's imports by 1 million metric tons. So not a lot of change, a number of small changes, but not a lot of big changes, and still some question marks on the world side. One of the things I guess we should point out, especially on the soybean side, but also on the corn side, there's a lot of estimates out there suggesting the South American production will actually be smaller than what USDA is projecting. And so it's still a little bit of a wild card there. And we were talking earlier, Nathan, about what would cause a pop to happen in August.
Yep.
It would be largely probably driven by a lack of supplies coming out of South America and the U.S. becoming the residual supplier earlier than expected or earlier than normal before the new harvest in the U.S. is available. And that's what happened previously. We saw that pop in export demand. We haven't seen any sign of that materializing so far. But that's probably maybe the concern, I suppose, or at least the speculation that some people might have out there. If you look at soybean exports to China versus exports to all destinations, obviously it's had a huge impact with the growth in our soybean exports to China. We're at total exports so far through the end of June at about 2.15 billion bushels. Just a little under 1.3 billion bushels of that went to China. If you look at those soybean exports, though, in June, they really slowed down. And that's one of the things I think that encouraged USDA to pull back a little bit on their 2020 crop year soybean export forecast, how slow soybean exports were in the month of June, and probably continuing it here in the early part of July. If you look at the export projections relative to what we've exported so far, we've exported about 95% of what USDA is projecting for exports. However, you have to remember that on this report, they did pull back the export forecast a little bit to help that 95% look a little better than it would have otherwise. I think without that, we would have been about 92 or 93%. So can we hit the target with just 5% left? Well, yeah, pretty good chance we can. Are we going to exceed that? Maybe not, unless Brazil gets out of the market in the month of August, would be my guess at this point. If you look at soybean ending stocks forecast on a month-to-month basis, like we did for corn, the picture's not exactly the same. In both cases, those carryover ending stocks came down sharp. The projections of them came down sharply as we headed through the 2020 marketing year. But the difference is, as you look at the late winter, early spring time frame, on the corn side, those ending stocks estimates kept coming down. On the soybean side, they stabilized, and here the last 2 months actually got bumped up just a little bit. So a little different scenario than what we saw on the corn side, but still a very tight stocks estimate, right? You can't, I was looking at one of the analyst reports here not too long ago, and the comment was, you can't pull ending stocks below 100 million bushels in this country, right? That's clearly a pipeline requirement. So we're hovering near the pipeline requirement with respect to soybean stocks being carried over into the 2021 crop year. And if you look at it as a percentage of usage, this year's projection just under 3%. The initial projections for the 2021 crop year going into the 2022 crop year, not much higher, currently about 3.5%. So that's probably going to change multiple times between now and then. But it suggests a very tight supply situation in soybeans continuing, not just this crop year, but into the next crop year.
That's truly amazing to see the stocks that tight for the next year. I mean, and the reason that's probably going to be borne out is there's going to be really stiff competition with corn. Given that corn's relatively tight stocks too, there's going to be a lot of competition in corn and soybeans in 2022.
And you're going to talk about that more later with respect to profitability. So we'll look at that a little more carefully with respect to what that looks like for the next crop year. On a world basis, world soybean stocks have really come down. Going back to the 2018 marketing year, we were up to 33%. Now we're down to roughly 25%. And really no projected change of any consequence going into the 2021 crop year. So relatively tight. That's not quite as tight as we were back in 2012 and 2013 when we got down to 22 and 23%, but it's pretty close. And does suggest that there continues to be ongoing pressure with respect to yield and production this year. And the yield on the soybean side is more up in the air than it is on the corn side. If you go back and think about the acreage, we were talking about the Dakotas, Minnesota, and Iowa. Those states combined are let me think about this for a second, up in the ballpark, give or take a couple of percentage, of about 1/3 of our soybean acreage in those states. So really, that won't be determined for several more weeks. Traditionally, August is typically the main month that you think about with respect to crop conditions on soybeans and impacting yield. So certainly a lot of uncertainty and some risk given the large percentage of acreage in those states. Now, Nathan, you've taken a look at the basis on the soybean side, and this chart looks different than what you showed us on corn.
That's right. So we got a quite a bit different situation going on with soybean basis. So again, I'm looking right into kind of deferred soybean basis relative to that nearby contract. So we're looking at basis relative to the August 21 contract throughout the crop marketing year. And we're looking at central Indiana. And so what we've seen here over the past 6 to 8 weeks is a pretty steady decline in soybean basis. And so where soybean basis was as high as $1.50, so $1.50 over futures back in the first week or two of May, we're now only about 55 cents above, $1.53 above historical average basis, not above futures. It's come down to being only about 55 cents above that historical average. Some of that is because there tends to be a positive kind of trend in soybean basis even into those summer months. And so, the historical average is higher today than it was back in May. But a lot of that has been due to the decline in basis levels this year. And so again, as we've talked about previously, we've kind of looked at different thresholds for what the potential for soybean basis might be this summer. We've had strong basis all year, and so we've had some pretty favorable basis levels, but we never saw those late summer kind of pops that we had talked about previously materialize. And if anything, we've seen soybean basis really moving in the other direction. So
an interesting development you and I were talking about, I guess, a week or so ago, is the fact that as we look at some of the bids and some of the elevators and terminals here in the Eastern Corn Belt, instead of using, as you did here, August as your baseline for establishing your bids, some of them are actually using new crop futures. They're using November futures to compute their summer bids here.
Right.
And at first glance, it's a very strong basis relative to November, but it's an interesting development. It's not one that we see. I couldn't remember truthfully the last time we saw this. So let's talk about that a little bit. What's going on?
Yeah, so it kind of caught us off guard, right? Because when I went and was looking at some bids, I tend to think in terms of basis with the basis tool, and was comparing some of those bids to what I was seeing in the tool, and they were quite off. And so we finally caught on and noticed what they were doing, using those new crop futures to set those summer bids, and then using basis to kind of make up the difference of how they wanted to pull in corn or soybeans, because it was on both, I believe, was it not?
Mostly I noticed on soybeans, but I think some of it was on corn as well.
I think a little bit of both, but you're right. I think you're right. It was mostly on soybeans. And so really, thinking through what's going on there, it's clearly an indication that those buyers are saying, we're thinking about new crop. We're thinking about what's going to happen with the new crop corn. We're not as worried about as what's going on in terms of old crop, what's left. We're more worried about the conditions of the new crop, right? At least that's how I interpret it. I don't know if you saw some other things to
Yeah, I think the same thought, and then I may be taking that a step further. I think what's going on is that some of the merchandisers are worried that with the soybean stocks as tight as they are, they're worried about a squeeze with respect to deliverable supplies at the delivery points that are in the futures contract. And so the easy way to get around that is just say, well, we're going to focus on what the new crop is doing, because we think that will be reflective of kind of general supply-demand conditions, not just what's taking place at those delivery points. But I agree with you. It also suggests that they feel like they're not having much trouble fulfilling their needs.
Right.
So that doesn't bode well for seeing additional strength in soybean basis, even though the projected carryover is as tight as it is.
Which is kind of an interesting dynamic, right?
Yeah.
So then, again, kind of shifting gears and thinking about new crop opportunities on soybeans, we've kind of, again, been pushing this, kind of getting people to think about what those opportunities might look like. This morning, new crop November soybeans were trading for $13.61. Again, making an adjustment for basis. I'm using the basis tool in central Indiana as kind of the region that I'm looking at. You would use whatever basis would be relevant for you. That puts us at an expected harvest cash price of $13.31. And again, the story is very similar to what I said for corn. On one hand, that's certainly not as high as we've seen that number as we put this chart up every month in our webinar in the past several months. But when you compare that to break evens, right, we're still looking at very profitable levels. And so as you kind of make your kind of decisions and you're evaluating some of those opportunities, it's not too late to act, I guess is the point. I think some people may have think, well, I missed it, it's too late, I'm not going to do anything. And I think that would be, in my opinion, the wrong mentality, right? Still maybe take some positions, and again, not on everything. Like we've said, the stocks conditions on soybeans is very tight. I know there's a lot of people with a lot of very, very bullish on soybeans, and I think there's reason to be. But again, as I'm going to show in some of these next couple of charts, there's still downside risk in the soybean market. So this is just, again, new crop November soybean futures going back to the fall of last year. And again, we've seen the run up, we've seen the volatility in recent months. That's not news to anybody. The scale of some of these swings has been pretty phenomenal to me as you think about shifts of $1 to $2 in just a couple of weeks, and not just once, right? It's not like the market broke and it was done. It came back and broke again, and so we've seen a lot of movement here. And so again, even though you might not have hit one of those peaks in the market, the $13.61 futures price we're looking at, and again, converting that to a cash price of somewhere in the $13.30 cash price, this is a very, very good price, well within kind of the average of what we've seen over the last 2 or 3 months. And so, don't let the fact that you missed the high, let the opportunity to lock in those profitable levels slip away.
Yeah, if I was a technical analyst, which I'm not, but if I was, I would look at the fact that we're in the ballpark of about a 50% retracement, right? So that's something a lot of the technicals like to look at. But, if you think about it from a downside risk perspective, you took a look at that as you did on the corn side.
That's right. So using the same tool and the same kind of framework for thinking about what the downside risk is here on soybean prices. Again, if we're in that $13.60 range of a price today, what's the potential for that to go down as we approach expiration of that contract in November? And so according to all the information that's pulled into this tool, the chances of a dollar decline in that price, so from $13.60 down to $12.60, is about 33% chance. So there's a third chance that we could see that price decrease by as much as $1. Taking that a step further, I think there's about a 15% chance that price could go down by $2 or more. That would put us at that $11.60 price range. And so those are big swings with relatively high probabilities associated with them. And so again, from my own kind of personal view, and again, as I mentioned, a lot of people, I'm not the only one saying this, the stock situation on soybeans is obviously much tighter. Everybody knows that, and so there probably is a little more upside potential there, but still there's downside risk. And so I think that there's certainly still opportunities on some portion of that new crop to be able to lock in some of these levels at the prices that we're seeing today, because they could certainly go down.
Michael, coming back and thinking about what those break-evens are, what are you currently projecting if there's a break-even on soybeans?
Break-evens for a lot of people are below $11. And so, $13 is a good soybean price. That's for sure. And let's talk a little bit more about that volatility. Why is there so much volatility? Let's circle back to what we talked about. This is a weather market. Yield could be a little higher than expected. That's the downside, what we're looking at here. Yield could be, if the yield is lower, we're looking at the upside here. And so just remember that weather could go either way.
Speaking of that, you took a look at the crop condition ratings.
Very similar story to what we saw in corn. I mean, Indiana's running quite a bit ahead of its 5-year average and the 18 major states with a really low good to excellent ratings occurring in that North Dakota, South Dakota, and Minnesota. North Dakota and South Dakota are even more important when it comes to soybeans, and so that's very important to watch. To see what those crop progress reports look like in the next couple of weeks, and that's going to be major for people that are watching this market real closely.
Yeah, so we've got about 1/3 of our acreage that people are really watching pretty closely in terms of what the weather patterns are. And so, All right, you've taken a look at income projections.
Yeah, the income projections are similar to what we saw last month, or we saw even in May. However, the income projections are down a little bit in 21 with a little bit of weakness in corn and soybean price projections compared to what they were a month ago. Probably the biggest change, though, is occurring in 2022. 2022 looks like it's going to be about the same as 2020. That's not necessarily bad news. Both of those are about right at what the average has been since 2007. A lot of good years in there, and so there certainly aren't bad years, but 22 does not look like it's going to be as good as 21. And just to remind the viewer or those listening on the podcast that the reason why 21 is pretty high, it's not just that we've got fairly strong prices this fall, it's also the prices that we received after the first year for the 2020 crop. So it's a combination of those two things that makes 21 look pretty good.
So, you and I do the Ag Economy Barometer, Michael, and I look at this chart and I see how sharply down 2022 is relative to 2021, and that might explain some of the weakness or softness we've seen in the Ag Economy Barometer, that sentiment index recently.
Yeah, I think that's part of it. I think we're also going to talk a little bit about price inflation. I think that's also playing in terms of the sentiment. Looking at cash rents, there's still very strong upward pressure on cash rents. The forecast for corn and soybean net return to land is down about $50 from June, but it's still very high by historical standards. It's very, very similar. It's lower, but it's similar to 2011, which was the highest in that 2007 to the current period. So very strong net return prospects for 21. That looks like they're also going to be pretty strong in 2022. If you look at the long run net return to land, inflation adjusted since 1960, I'm going to go back a ways here, but if you go back to 1960 to today, the average inflation adjusted net return to land is 250. And so 310 that we're currently projecting for 2022, that looks pretty good. And certainly the 21 looks pretty good. And so that's why we're seeing this strong upward pressure on cash rent. And like I've been telling people, when you have 3 years in a row of very strong returns, like we're seeing here for 2020, 2021, and 2022, it's the perfect avenue for large increases in cash rent. If you go back to that 2007, 2013 period, 10, 11, and 12, all three of those years had cash rent increases above 10%. We could see that for 2022. Looking at the difference between corn and soybeans, all I want to talk about here is the fact that there's going to be a lot of competition for acres between corn and soybeans. That profitability goes from slightly more profitable for corn to slightly more profitable to soybeans, depending on that relative price. But both of those are going to look quite attractive from a net return standpoint. It's not just corn or just soybeans like it was during that 13 to 18 period where soybeans were more profitable, and then before that corn was more profitable. We're entering a different environment where both of them are going to be very competitive. The 21, in terms of 21, it looks like it's going to be about the same profitability for both.
So looking at 2022, we're in that time frame when people are starting to do some input selection for next year, especially on the seeding side, especially on corn hybrids. And so as you think about your production costs for 2022, one of the things people are talking about, in addition to potential rises in for example, seed corn prices, also this run-up we've seen in fertilizer values.
Yeah, and I'd be cautious if I was thinking about continuous corn in 2022 for various reasons. First of all, if you look at downside risk from a price standpoint, going way out into the December 2022 contract for corn and November for soybeans, there seems to be more downside risk for corn. And so if we see both lower prices for both corn and soybeans, I think soybeans are going to look more attractive, quite frankly, because corn price is going to drop below the break even. There's a chance it could drop below the break even, a much larger chance than soybeans, and so that's something to be cautious about with continuous corn. But also, like you said, the input costs. We're looking at increases in cash rent, which would affect both of them, but increases in possible increase in fertilizer prices. That weighs more heavily with corn. Obviously, corn seed is more expensive than soybean seed, and so there's inflation risk there. Also, fuel it impacts corn a little bit more than soybeans, and so there's just a lot of reasons why I would be very cautious at this point of growing much continuous corn.
So,
except as you go further in the western corn belt, like Nebraska, Nebraska usually has 2-to-1 corn, but even Iowa and Illinois, I think it's going to be more. It's going to be closer to 50 or 52% corn rather than that 55% or above that we sometimes see.
So when you estimated returns for 2022, what did you do with some of those input costs? How did you factor those in?
That's difficult to do. I certainly probably have a better forecast for cash rent. I did expect those to increase 5% each year. That might not be enough for 2022, so I probably wasn't cautious enough there. I did have some increases factored in using some long-run forecasts from the University of Missouri FAPRI. They come up with prices paid indices for the next 10 years, and I use their estimates for the next year to try to come up with some estimates. And so I didn't use flat costs. That's very important. I did build in some inflation in prices paid. Whether I build in enough, who knows? All I want to talk a little bit about is how that compares to the June. Certainly, corn looked a little better in June for 21, but the 2022 story hasn't changed. Both corn and soybeans are going to be very competitive in 2022. I did look at what would happen to 21 and 22 harvest future to net return to land if we were seeing 21 and 22 lower harvest futures prices.
And so to bring that back in perspective, this is looking at the price discovery tool from Illinois and looking at those possibility of a significant decline, that 25% chance of a 13% decline in D's corn, 18% decline in D's 22 corn price, and then it's similar on the soybean side, right?
For those that might be a little familiar with that tool, and I encourage our listener to take a look at that tool. It's very useful if you're looking at futures prices and the band around futures prices. I was looking at that 25 percentile. So what is that? That means there's a 25% chance that corn or soybean prices could be that low. And so we're not talking about trivial percentages here, trivial percentage changes here. And of course that changes 21 and 22 mightily. For 21, that would show us a net return to land of $304 rather than $384. So that's an $80 drop. Again, thinking about your marketing strategies, because certainly that's possible to see that $80 drop. And then 2022, it brings that net return to land below projected cash rent by about $40. And so the main reason I went through this exercise is when you're negotiating cash rent for 22, just be a little bit cautious. You need to think about not only what the 2020 returns were and the 21 net returns, but think about what 22 might look like, and even further than that. I mean, there's still some chance for some downside in terms of net returns, 22 and beyond. And so let's don't be too aggressive. It's not, I think we're, in other words, we're in a different situation, I think. And maybe you guys argue with me on this, and you're willing, you're more than, I would accept an argument and maybe argue with you about this. I don't think we're in that 2007 to 2013 period. We're not in that window where we saw several years in a row of very strong returns. I'm not convinced we're there. And so that means being a little bit more cautious with cash rent in 22 than you probably were back in 10, 11, 12.
So I think that truthfully leads us into a question that one of our potential viewers sent us in before the webinar today, which was, what do we think is going to happen longer term with respect to demand from China? Because if you think about contrasting what's going on now versus that 07 to 12 or 13 time frame, that 07 to 13 time frame was characterized largely by a strength in demand from multiple sources. Part of it was from China, part of it was domestic. And the current environment is mostly characterized by strength in demand from China, with a little bit of maybe crops not being quite as large as we thought in the U.S., so a little bit of supply side issue there, and definitely some supply side issues in South America. I agree with you. It's not the same as what we saw before, and the odds of this lasting as long as what we saw in that 07 to 12 or 13 time frame don't appear very good.
Yeah. There's still some legs there. I mean, it's obviously there's a lot of uncertainty. I think that corn in particular, China historically has grown all the corn they need for their livestock industry, and so the question is, are they going to come close to returning to that in the next year or two? I think I'm a little bit of a naysayer there. As their population demands more meat in the diet, they want a better diet. Their demand for livestock is going to increase, and maybe they can't produce enough corn for not only this year, but maybe 2-3 years down the road. I think that's an open question. Whether they import as much as they did this year, probably not. But I don't think it's necessarily going to go back to zero. I'd like to get you guys' thought on that.
I would agree with that. I don't think it's going to go back to zero, but I don't think we can count on the level of demand we've gotten over the last year or so.
No, that's probably not going to happen.
What's your perspective?
Yeah, I agree. It probably doesn't go back to zero, but to sustain where we're at seems unlikely.
So we talked a little bit about this earlier, Michael, but we wanted to share some information we've gathered from producers, and that is we've asked producers on the Ag Economy Barometer this last month what their perspective is on prices paid for farm inputs. And we gave them a little bit of history or perspective when we asked the question. We pointed out that over the last 10 years, the average price paid for farm inputs has increased by just less than 2%, about 1.8% per year. And using that as a frame of reference, we asked them, what do you think is going to happen during the next 12 months? And we were surprised by the responses. First of all, there's a lot of disparity there. But the key point is a lot of producers are expecting quite a bit of price inflation with respect to farm inputs, right?
Yeah, if you look at 8 to 12% and over 12%, 8% would be 4 times that historical 10-year average. Almost a third of the producers were expecting either over 8% in terms of increases in prices paid. That's more than cash rent, I think, and so there's pressure on a lot of different cost items, and that's really reflected in this question that we asked them. And so certainly inflation's a real concern for agriculture producers right now. Is that going to make it necessarily unprofitable in 2022? Well, that depends on what the prices are. You look at the current futures prices, even building in some of a fairly large price inflation, you're still looking at a pretty good situation for 22.
But it does indicate that you need to pay close attention to your budgets, right, and manage those costs, because particularly as you get on the upper end of that, and some of the things in agriculture, we also asked a question about consumer price inflation as well, and the responses weren't quite as positive as what we're picking up here. But nevertheless, on the ag side, we've already seen some significant increases, and if we see these compound, it starts to really eat into those margins, right?
And as you know, I get excited about crop budgets. I update them very frequently. Let's put it that way. And for the last 5 years, it's been kind of boring, if you will. There really hasn't been much price inflation at all. The 10-year average is 1.8%. It's almost zero in the last 5 years. And so really, if you did a budget 2 years ago, you could trot that out. You trot that out this spring, and it wouldn't have been too much different. That's not going to be the case moving forward. We really need to sharpen our pencil and look at those enterprise budgets when you're looking at the relative profitability for corn, soybeans, and wheat in so much of the country, because it's a different world. We're looking at inflation in different inputs, and which are going to impact corn probably more than soybeans, and so it's going to be very, very important to develop enterprise budgets by field.
So you've just built some demand for the next webinar when we'll have updated crop budgets,
Yes.
because I think your projections on the 2022 crop are going to change as we get closer and get a little better grip on what some of those input prices might be.
And next month we'll know what the Purdue cash rent and land value survey, we'll know the results for that, and so we'll know what the cash rent was in 21.
Yeah, that's a good point. And we'll have a webinar to discuss that in some detail as well. So that wraps up our discussion for today. Our next webinar will be on Friday, August 13th. The details for that will be available on our website, purdue.edu/commercialag. And with that, I want to thank my colleagues, Nathan Thompson and Michael Langemeier, for joining us today. And on behalf of the Center for Commercial Agriculture, I'm Jim Mintert.